Hello class, we are group 6 and today we will be doing an informative presentation on open banking. In the simplest terms, open banking is a framework that will reshape the financial landscape for both banks and consumers by enabling third parties to have access to customers' financial data. Some of the impacts of open banking include providing a more holistic view of finances for banks, customers, and third parties, providing better customer experiences because of the transparency with customers' finances. This will also help improve customer retention, and new revenue streams will also be a result of the expansion of customer reach by creating more comprehensive offerings for customers who want a more holistic view of their finances.
Hey everyone, my name's Trevor, and I'm going to be talking to y'all about open banking in Europe and the United States and kind of a little bit about how it got started. So, open banking rose to prominence in Europe with the onset of regulatory measure PSD2, but the development of this measure has been in works since early online banking in the 80s and builds upon the regulatory standards created by PSD1. So, PSD1's main goal was to regulate and harmonize payments in Europe and reassure customers with concerns about security, data privacy, and speed. The focus shifted with PSD2, as it focused on breaking up a bank's monopoly on consumer data and to promote interoperability between the financial institutions and third parties. Open banking in Europe via these regulations allow the further development in data enrichment, automated financial management, intelligence, analytics, and smart credit scoring. And I think an important point to look at here is on the very final bullet point of the slide. It talks about where this first originated, which was in the UK, but Europe was the first place that they actually enacted regulatory measures for open banking. And as they rolled these out, Brazil, Australia, Saudi Arabia followed suit. Meanwhile, countries like America and India, which are more agency and private sector driven, had a different plan. And I'll address that in the next slide. So, like I was saying, the United States government has currently declined to create regulatory mandates for its firms and banks. Instead, it has opted to continue to grow through companies like Mint, PayPal, Amazon, Google, and Intuit, and they have all band together to create coalitions like Financial Innovations Now that work to speed up the industry innovation in this sector. Open banking began here by relying on screen scraping directly off websites to grab info and present it in other forums. But most account aggregation is done by direct data feeds. And the examples of this would be Microsoft Money back in the day. You had to manually enter everything, but Mint has automated that process. And another example might be an Intuit QuickBooks or TurboTax. When you're filing your taxes and you go to look up your previous tax returns, they have a button that allows them to connect to the IRS via your information and take all that data off for you. And that's another example of how that might work. And we've seen that while there are no regulatory measures from the government, there is a growing favorability towards open banking by the United States. And that's what this chart shows here. These younger generations are much more open to the idea of it. And there are even some senators and lawmakers that are recommending that we move towards some sort of open banking profile. And really, the struggles that we're going to be working to overcome is going to be combating identity theft, inappropriate sharing of data, unwanted target ads, and loss of funds and payment errors. So it'll be really interesting to see how these companies wield their power to mold open banking and if the United States government ever decides to wield their own power via regulatory measures.
Some of the impacts of PSD2 include these new regulations, which are labeled as AISPs and PISPs. Account information providers authorize access and retrieve account data provided by the financial institutions. Cases include aggregating users' financial data and sharing them with third parties. Money management tools powered by aggregating users' financial information in a simplified format. Payment initiation service providers are companies that are not banks, central banks, or government agencies which are conducting financial transactions. Ultimately, PSD1 improved the transparency and security in online payments and transactions, which included transparency with banks and other PSPs about fees, charges, and services. Some advantages to open banking include more transparency into customers' finances, improved customer satisfaction and retention rates, enabling banks to move in a banking as a service and working with other fintech companies, increasing revenues and customer reach, as well as offering a much wider variety of services.
Consumers tend to be generally receptive to open banking, and many see the concept to be valuable, particularly the young generation between 18 and 21 years old, in which 48% of those consider it to be valuable. The reason for this is that they find it attractive that financial offerings can be more flexible and transparent with the advent of open banking. And even though the number goes down as the consumers get older, there's still a considerable amount of people, especially those who are high earners with over $250,000 in annual income, who support the idea of open banking and consider it to be very valuable. Concerns among consumers regarding open banking have many issues with security. For instance, identity theft is a concern shared by almost 70% of all consumers. Following that are issues with consent, such as the use of data for purposes other than consented, or sharing data without consent. Privacy is clearly a shared issue among consumers, and it is prioritized over other concerns such as losses of funds or payment errors.
Banking as a service relates to open banking because it consists of banks opening up their APIs to third parties, but it's far more than just data sharing. Banking as a service provides non-banks the opportunity to offer banking products embedded into their own core offerings and highlights core financial services as opposed to just the access to data. Open banking alone does not provide third-party providers to use financial services in their own offerings. Historically, something like this would cost massive amounts of resources and time because of regulation and licensing obstacles. But today, fintech companies can offer financial services without the requirement of a banking charter. Healthy competition is encouraged through banking as a service by allowing non-banks to offer financial services, providing customers more financial transparency. Sponsored banks will provide the core financial products, while software and tech firms provide the banking as a service infrastructure. For example, some banking as a service technology infrastructure companies are Bond and Synapse, and some sponsor banks could be MetaBank and Celtic Bank. For legacy banks, banking as a service provides an opportunity to create new revenue streams by allowing third parties to use their underlying infrastructure, data, and banking licenses. Many high-profile fintech companies don't have bank charters. Instead, they offer their banking products while a licensed banking-as-a-service provider handles the back end. Furthermore, many players are paying a significant premium for the data acquired by third parties. Some banking-as-a-service players include licensed banks who act as agents for front-end companies that are offering the products. For example, in 2019, Apple introduced the Apple Card in a partnership with Goldman Sachs. Goldman Sachs issues the cards as well as the lines of credit, while Apple handles the front end, with the card being linked to Apple Pay and Wallet iOS.
Through an interview with Stephen McKean, the CEO of Apex Edge, the real-world application of open banking can be seen to everybody. The company noticed that consumers were being overcharged by about $50 billion per year, which is well over $1,000 per family. And the company has a goal of reducing these costs for consumers in order to ensure a sustained relationship and that their clients don't leave to go work with other competitors. By utilizing open banking, Apex Edge can provide financial relief for their clients and in turn better mental health for their customers via bill negotiation, subscription management, and other internet optimization services. Now that the company has more access to financial data of their consumers, they can use AI-based probability tools to scan the data and determine how each client should be helped. The company's expectation is that unit costs will decrease through AI and machine learning, And once the artificial intelligence is able to detect an area that might need to be discussed by the company and the client, the humans are able to take over and discuss this intimately with each client. All interactions with the Apex Edge platform are encrypted and monitored using API services to ensure security for each client.
Financial Technology Partners, or FT Partners, are an investment banking firm that focuses on fintech. They publish research reports on transactions, trends, and insights. They also advise different companies in large transactions. They're currently recognized as the largest fintech advisory practice in the world. They did a report on challenger banks where they found that incumbent banks have decided to launch their own fintech brands in response to the growth of digital banks that are providing financial services online. Another report shows that the use of mobile and internet to provide financial services have surpassed traditional banking options in Africa. This is primarily due to the fact that Africa is an attractive option to fintech companies because of its underdeveloped financial services ecosystem. Another report that they have done expects financial service providers to implement credit lifecycle management solutions rather than focusing on providing only credit information to consumers. This would be similar to how financial advisors use credit data and market analysis to make investment decisions. Other than these reports, FT Partners have been a part of numerous transactions. An example of a transaction is when they partnered with Finicity, a provider of financial data access and insights. In June 2020, MasterCard acquired Finicity in the hopes of providing more choice of financial services for MasterCard users, as well as to show their commitment to fintech companies. In this transaction, FT Partners provided financial and strategic advice and supported the company in what became a $1 billion sale.